And welcome back to the Business Spotlight. I'm Pat Dewar. My guest today is Jeff Pickering. He's a CPA in the Plano area. He has a master's in taxation. He is my CPA. I will just blatantly throw that out there. And I encourage you to listen in. If you're a business owner, you need to pay attention because Jeff has some great information and tools, tips, and techniques to maybe save you a little bit of fuss from the IRS?
Yes, that's right, the hassle. And I'd like everybody to know that although the firm has my name, I do have other CPAs who are working for me and some other accountants as well. And I've always attributed whatever my business is to my great staff. I'm really proud of them, and I couldn't have had, I couldn't ask for any better staff than the one I have.
I agree. You have an excellent staff. They take care of us every year. One of the things that's always important for business owners to look at during this time period is how do I reduce my payments, so to speak, to the IRS?
Right. So I can speak in general terms. What your general strategies are for the business. In business, what you want to do is you want to accelerate deductions and delay the income if you can. So whatever tricks you can do to accelerate deductions, and one of the most popular ones is to buy equipment at the end of the year or anything else that you're thinking of doing. Now, for some people, they'll be able to prepay some expenses.
Okay.
That's specific to the individual business, because some won't. The IRS has rules and lots of different ways to keep people from deducting things that would normally be deductible.
Right.
So, but if you can prepay stuff, that's usually a good way to do it. If you can extend your income, maybe that invoice is going to be due in January instead of December. That's a great way to do it. Taking a look around and investing in things that you would normally have invested in the first quarter. Just take them in the last quarter.
So that'd be like things like training or just about any expense.
Training, marketing. I always love training. I'm glad you brought that up because it's always an investment in yourself and your staff. To me, it's a wonderful write-off.
Okay. What about retirement type of things? I know you're not you don't do investments, but do you recommend that they?
Yes. So there are some very powerful retirement tools. My personal favorite for a small corporation, like a one or a two, like a husband-wife corporation,
right,
is the individual 401k.
Really?
Yes.
Okay.
So that
Why?
one, well, because you can get huge deductions for a small amount of wages. For instance, if you have $30,000 of wages, you can deduct $22,000 and put it in your 401k.
Really?
So yeah, it's huge.
So people that are listening to this that may not have a corporation, they might want to, Now, is it incorporated or DBA? I mean, does it matter in that instance with the 401k?
It doesn't. The rules are slightly different from somebody who's a sole proprietor and somebody who's a corporation. They're kind of close, but they're not exactly right. So
Right.
there's a little adjustment in there. I would say that for somebody that's just doing a DBA, they should really look seriously about the benefits of incorporating.
Very cool.
There's a lot of stuff. My clients tell me they get confused by going out on and reading blogs and what other people say, and unfortunately, all these blogs are turning. They're turning the internet into a one giant water cooler or a barber shop, where people just sit there and
And the information is always so accurate at the water.
That's right.
Water fountain.
Well, my barber says I can write off my. Right.
Well, I mean, obviously, getting good tax advice is key. But
Yeah.
the one thing that I see in that is that that's an enormous benefit.
Sure.
Is what I'm hearing. What else can they do?
Well, there is a deduction which right now I'm gonna say maybe has a 60% chance of making it before the end of the year, and that's 100% bonus depreciation, or 50% bonus. 100% was 2012. So 50% bonus depreciation is a little different than what we used to call, or what we call Section 179, which business owners, they usually hear this, Section 179. I don't like to talk about code sections, as you know, because for most people, it's just going to
Their eyes glaze over and
exactly.
they go, yeah.
But Section 179 is one that's very popular, and it's probably the only one that people actually remember. And what it is, it allows you to purchase something and deduct the whole thing in the year that you purchase, instead of over 5 years or 7 years or 15 years, which is the normal IRS rule.
Now, what's the something that you're thinking, like a truck or a piece of equipment?
Well, traditionally, the nice thing for people to do is to buy a truck.
Okay.
Or for bonus depreciation, it doesn't even have to be a truck. It could be a sedan or other things. Section 179 usually means that you have to buy a 6,000-pound vehicle.
Okay.
So you think SUV. I think the X5 is typically, I think they put extra weight on it just so it qualifies for the tax deduction.
Let me do this real quick. Folks, we're listening to Jeff Pickering. He has a master's in taxation. This is the Business Spotlight, and we'll be right back in just a few moments after we hear from our sponsor.